On July 4th, 2025, Independence Day, President Trump signed a 900-page bill into law. It was called the One Big Beautiful Bill, and the headline was simple: Americans are getting a tax cut. No tax on tips, no tax on overtime, lower brackets, bigger standard deduction, more money in your pocket. That's what you heard. Here's what they didn't say. The same bill quietly cuts $880 billion from Medicaid over 10 years. It cuts $187 billion from the food assistance program that feeds 42 million Americans. It eliminates federal student loan programs that millions of families were counting on for this coming school year. And it adds, by the Congressional Budget Office's own estimate, $4.1 trillion to the national debt by 2034. The tax cut is real. What it costs you over time, through your family, through your community, is also real. Nobody put that part in the headline. Today, we're going to. Let's start with the part that's genuinely true, because this bill does put money back in some people's pockets, and you deserve to know exactly how much and for who. First, the tax brackets. Under the 2017 Tax Cuts and Jobs Act, your income tax rates were lowered. Those cuts were always scheduled to expire at the end of 2025. Without this bill, a family earning $80,000 would have seen their tax rate on a portion of their income jump from 12% back to 15%. The One Big Beautiful Bill makes those lower rates permanent. For a median American household earning around $78,000, that's roughly $1,000 more per year in take-home pay. Second, the standard deduction. It went up again to $15,750 for single filers, $31,500 for married couples. That's the amount of income you pay zero federal tax on. That's real money for most families. Third, no tax on tips. If you work in a restaurant, a salon, a rideshare, you can now deduct up to $25,000 in tips from your federal taxable income through 2028. Fourth, no tax on overtime. If you work hourly and clock overtime hours, you can deduct up to $12,500 in overtime pay. Also, through 2028. Those four things are real. They're in the law. And if you're a middle-income earner, they will show up in your paycheck or your tax refund. But here's what most coverage missed. The no tax on tips deduction only helps you if you actually owe federal income tax. A single worker earning $15,000 in 2026 pays zero federal income tax anyway. The standard deduction already covers it, so the deduction gives them nothing. Therefore, the workers who benefit most from no tax on tips are the higher-earning tipped workers, the ones earning $70,000, $80,000, $90,000 a year in tips at high-end restaurants and clubs, not the minimum wage server at your local diner. That's not an opinion. That's how a deduction mathematically works. Now let's talk about what the bill takes away. And I want to be precise here, because this is the part where the numbers get used loosely by everyone, on every side of the debate. The bill cuts $880 billion from Medicaid over 10 years. Medicaid is not welfare for the unemployed. Medicaid is the largest payer of nursing home care in the United States. 62% of all nursing home residents are on Medicaid. If you're between 35 and 50 years old and you have a parent in their 60s or 70s, this is the program that pays their nursing home bill when their savings run out. The average nursing home costs over $10,000 a month. Almost nobody can pay that privately for more than a year or two. The bill introduces work requirements for Medicaid. Able-bodied adults between 19 and 64 must now prove they're working, studying, or volunteering at least 80 hours a month to keep their coverage. The Congressional Budget Office estimates 11.8 million Americans will lose Medicaid coverage over the next decade as a result. Now, the bill's supporters argue many of those people will find jobs and get employer coverage instead. That's a legitimate argument. Here's the counter-argument, also from the data. The states that already ran work requirement pilots, Arkansas was the biggest, saw people lose coverage not because they stopped working, but because they couldn't navigate the paperwork to prove they were working. The administrative burden itself knocked people off. But the nursing home issue is separate from the work requirement debate entirely. Nobody puts a 75-year-old with dementia in a nursing home and expects them to work. Therefore, the cut to long-term care Medicaid funding is the one that will land on the kitchen table of middle-class families in ways they are not currently expecting. Three more pieces of this bill that deserve plain language. 1. Food stamps, officially called SNAP. 42 million Americans use SNAP benefits. The One Big Beautiful Bill cuts $187 billion from SNAP over 10 years. The mechanism is this. For the first time ever, states will now have to pay a share of SNAP benefit costs, between 5 and 15%, depending on the state's error rate in administering the program. States that can't afford that new cost will cut benefits to balance their budgets. This isn't a projection. Several states have already announced they're reviewing their SNAP programs in light of the new funding structure. 2. Student loans. The bill eliminates Grad Plus loans, the federal loan program that graduate students use to fund medical school, law school, and MBA programs. It also caps Parent Plus loans at $65,000 lifetime, a number that doesn't cover 4 years at most private universities. For families who had already planned their child's college finances around these programs, the deadline hit in August 2025. Families who needed the money for fall 2025 found the window closed. They were pushed into private student loans, where interest rates run significantly higher than federal rates. 3. Clean energy tax credits gone. The bill eliminates the federal tax credit for electric vehicles. It eliminates credits for home solar panels, energy-efficient windows, insulation, and heat pumps. These are credits that middle-class homeowners in their 30s and 40s were actively using to cut their energy bills. But here's the thing worth saying plainly about all three. The bill's architects would argue these cuts fund the tax cuts, reduce the deficit contribution, and remove government interference from markets. Those are coherent arguments. Therefore, what we're doing today isn't telling you the bill is good or bad. We're telling you what it actually contains, so you can make that call yourself. Here's the part that almost nobody is covering, because it doesn't hit until later, but it will hit. The Congressional Budget Office, which is a non-partisan government agency, not a think tank with an agenda, estimates the one big beautiful bill adds $4.1 trillion to the national debt over 10 years. The national debt is already $36 trillion. This bill adds more than 10% of the entire existing debt in one piece of legislation. Why does that matter to a 40-year-old American? Because the interest payments on that debt are already the fastest-growing line item in the entire federal budget. In 2024, the US government spent more on interest on the national debt than it spent on the entire defense budget. More than Medicare, more than Social Security. Every dollar spent on interest is a dollar not spent on roads, schools, veterans, disaster relief, or on keeping the programs that a 40-year-old will need when they're 60. There is also a specific mechanism called pay-go, pay-as-you-go, that is triggered automatically when new legislation increases the deficit beyond certain thresholds. Pay-go requires automatic cuts to Medicare and other mandatory programs to offset deficit increases. The bill's supporters push through a pay-go waiver, meaning this particular bill won't trigger those automatic cuts immediately. But the debt it adds doesn't disappear. And the next Congress, facing a $39 trillion debt, will have to make choices. Those choices will involve the programs that today's 40-year-olds will need when they're in their 60s and 70s. But here is the honest other side. The bill's economic supporters, including the Tax Foundation, project that the permanent tax cuts will stimulate enough economic growth to offset a significant portion of the deficit impact, adding approximately half a percentage point to real GDP growth per year. Therefore, whether the debt math works out depends on whether that growth projection is accurate, and economists genuinely disagree on that question. Let's close with the clearest summary of the numbers. Not politics, just arithmetic. The richest 1% of Americans will receive an average tax cut of $65,000 in 2026 from this bill. The middle 20%, the actual middle class, will receive an average tax cut of about $1,500. The bottom 20%, the lowest income Americans, will receive an average tax cut of $110, but they will lose more than that through cuts to SNAP and Medicaid. According to the Yale Budget Lab, one of the most widely cited nonpartisan economic research institutions in the United States, the bottom 40% of Americans are worse off on net once you account for both the tax cuts and the program cuts together. The top 60% come out ahead on net. Is that fair? Reasonable people disagree. Some economists argue that growing the economy lifts everyone eventually, and that these cuts remove government dependency that held people back. Others argue that cutting food assistance and health care for the poorest Americans to fund a tax cut that benefits primarily the wealthy is simply wrong. We're not here to settle that debate. We're here to give you the numbers so you can have it yourself, with the actual facts in front of you. The bill is 900 pages long. Nobody in Washington expected you to read it. They were right. But here's what's buried on page after page, in language designed to sound like a gift. For every dollar this bill puts back in your pocket, it takes between $2 and $4 away from someone in your family who will need a doctor or food or a college loan in the next 4 years. That's not politics, that's arithmetic, and it's already law. If this gave you a clearer picture of something that's already affecting your paycheck, your parents, or your kids' college plans, share it with one person in your family who needs to know. That's how this channel grows, not through outrage, but through information that changes how you read the news. We post every Wednesday. Subscribe if you want to know what's coming for your wallet next.